advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome back to Something More with Chris Boyd. I'm Jeff Perry, sitting in for Chris this week, and still with me in the studio is Jeff Tomaneng, a certified financial planner with Asset Management Resources. And so we're talking Financial Literacy Month. April is Financial Literacy Month, and before the break, we talked about the program that we have of Something More Mentoring, which you can check out on our website, amrfinancial.com, under the Services tab. Jeff, for this segment, I want to talk about an article that I sent to you. It was on cnbc.com. It was on April 1st in honor of Financial Literacy Month. If people would like to read it after our talk here today, they can go to cnbc.com and go down under Save and Invest. And the title of the article is Try This 30-Day Money Challenge to Get Smarter and More Successful with Your Money. This is radio. We don't have time to go through each one. But the first thing that they said was to identify your money goals and values. So that's just right on with what we were talking about before the news break about, they say values, but I just say whys. It's the same thing you were talking about. The second suggestion that I'd love to get your feedback is, what do you think about having an accountability partner? So, for a lot of things that are tough in life, and we try to do them ourselves, we're not always successful. But I kind of agree with the advice on the web there, on that article at CNBC. Like, when you have somebody either going through the same thing or someone that can check in with you, don't you think you're more likely to be successful?
In general, yes.
Mm-hmm.
I do believe that. I think it's a lot more helpful when it's someone who's a third party.
Mm-hmm.
And so that person, here in the article, they talk about a friend or a family member, and sometimes that can get a little bit tricky. And I think you just have to know who you are as a person, and whether it's Asset Management Resources or another financial advisory firm or another financial planning firm or even a financial coach of some sort. I think sometimes it's easier to have someone who's a third party.
Disconnected from all the family dynamics, maybe.
Because then you can kind of get into the, well, why did you stop at Dunk's last week to 5 times? And then you get into, well, you shopped at Whole Foods instead of going to Market Basket. And so that's where you can kind of get into some he said, she said, they said type stuff. I like the idea of accountability buddy. I think it really depends on what the nature is of the relationship with who you choose as that accountability partner.
Yeah, those are good comments. And that's actually one of the benefits for the people who are subscribers to Something More Mentoring, not to keep talking about that, but it's related in that the mentor in the Something More Mentoring program not only is teaching you and guiding you through developing a financial plan, but is an accountability partner. Because if you agree with your mentor, in this case, about, say, the next topic about making a plan to reduce debt, that's one of the other things that are in the article, and you make a plan and you're not taking those steps to reduce debt, whatever those might be, that accountability partner or that mentor is going to be going back to you and saying, okay, according to our debt reduction schedule, you were supposed to have reduced debt by $400 last month, but I see that you haven't, right? So I get your point. It takes away the various drama and personal conflicts if it's someone too close to you, is what you're saying.
Very much so. I think the other thing I would say about accountability is that you don't look at it as punishment. Too often, I know how I was brought up, and it was, okay, if you don't do this, then you don't get to do that. I think it's less about punishment, just more about inspiration and keeping someone on the correct path.
Very
because
good.
we're all going to make mistakes, and you don't want your accountability partner to necessarily beat you up over it, but just say, hey, let's get you back on track and keep you going.
Right. And back to our conversation before, if you get off track with one of your financial goals, strategies, desires, it's okay. Give yourself some grace and get back on track. You don't have to wait till next January to make another New Year's resolution. You can get back on track today. So we're talking about an article that was on CNBC talking about financial literacy and some suggestions. One of them seems kind of basic, but I guess everyone hasn't done it, is start and build an emergency fund. How do you view, if someone came up to you, one of your clients or someone, came up to you and said, I think I should have a savings account or an emergency fund. How much should be in it? What would be your basic advice?
I think the general rules of thumb out there is first to try to get to 3 months. I think it also depends where you are in the life cycle.
When you say 3 months, you mean 3 months of your expenses?
I'm sorry, 3 months of your basic expenses.
Yep.
The things that when you're looking at a budget, these are the things that are set. So that could be your rent, your mortgage, electricity, whatever it takes to turn on the lights and for you to live.
Right.
Gas to get to your job, or budget for if you take public transportation, whatever it is.
The basics. You're not talking about going to Hawaii every month or gifts or anything like
habit
that.
At Pebble Beach or something like that.
Right. Basic expenses.
So, yes, basic expenses. So, I think, again, depends on where you are in the life cycle. If you're in your working years and there's going to be that income coming in, and that income is going to be increasing, maybe you're starting out with 3 to 6 months. As you approach retirement or a little bit later, when there are other expenses that can come up beyond the basics, then we like to see 6 to 12. So it really depends on the situation, but at the very basic, I'd like to see 3 months in case of loss of a job. The roof needs to be replaced. Your car breaks down, you need it repaired, or you need a down payment on a new one.
Right. And that'll serve as peace of mind as well. Some people who, and this isn't for just people of modest incomes. I think we should put that caveat in there, because there's plenty of people with good incomes, like significant incomes, that are still living paycheck to paycheck, that they haven't put money aside, they're not saving for their future, and they don't have an emergency fund. So don't think that just applies to people who are on the lower end of the income. This applies to all of us. So, and once you get that 3 to 6 months or even more, it gives you peace of mind, not only that financial protection, but it gives you an emotional protection that if something happens, there's a solution that's available to you without incurring more debt.
It's you brought it up. There are people who have really good incomes, making hundreds of thousands of dollars a year, who are spending at an exorbitant clip.
Right.
And then there are people who have modest incomes, who are just living off Social Security and modest investments, who have saved and have lowered their expenses, are living a very comfortable life.
Right.
And it's amazing to see what the difference is, between the two. If this might not be the way you were going with this conversation, but I think one of the topics in this book, in this article, was picking up a personal finance book. And this kind of leads me into one book that I'm sure you've read and that I know that I've read, which is The Millionaire Next Door.
I thought that's where you might go.
Yeah. And so, I'm actually now reading The Next Millionaire Next Door, who it's Tom Stanley's daughter, who's the original author who wrote that one. And, you think about, I remember in the original book, they said that the number one automobile owned by millionaires was, I think it was the Ford F-150.
Yeah, and the Toyota Camry was right behind
Toyota
it.
Camry. It
Yeah,
was just really basic.
yep.
Like it wasn't a BMW, it wasn't a Bentley or a Mercedes or a Lexus. It was, a Camry or a Ford F-150. I mean, just very basic stuff.
Yeah, don't get fooled by your neighbors who have 2 brand new cars and all these fancy clothes. They could be broke. Don't get fooled by image, and don't get fooled by apparent affluence or wealth. So you don't know the story behind the story. You only know your own story. And don't try to keep up with people who may be borrowing money or maybe spending money that they don't have. Tens of thousands or hundreds of thousands of people in the country every year go bankrupt because of overspending, over consuming. So have your own plan, be your own person, and make your own goals, dreams, and stick with them. That book is great. Another book on the same topic is Everyday Millionaire. It was written by the Ramsey folks, and it's statistical in nature, but it's also told in narrative storytelling. So there's a lot of great examples of how people have found wealth, made wealth, and haven't had that big income out there to be inspired by. You don't have to make hundreds of thousands of dollars to have a financial successful life and a comfortable retirement and be able to do things with your friends and your families that you paid for yourself because you saved. So that talks about, that's a great segue into having a budget, another thing that we should all do. So I'm retired from a public life of law enforcement and politics, and now working with AMR. But I've had a budget when I had no money, and I have a budget today. And my wife and I still review it quarterly. It means a little bit less now that we're comfortable, but it has guided us, and it is something that I think everyone, and I don't, unless you're the super wealthy people, who have people doing everything for you, but practically everyone should have some type of budget or some type of cash flow to make sure that they are intentional about where they want their dollars to go.
And that goes back, again, we can tie that back into the early topic of goal setting. What are some of those goals, and how do you set aside money for those things? How do you fit those things into your budget beyond the basics that we were talking about? So, it could be, we talked about college education, but maybe there's, I want to take my grandkids or kids on a super vacation.
Right.
Let's say that's for someone who's, into retirement, but they just had this dream of, hey, I want to take the kids and grandkids on this super vacation. I know it's going to cost 20 grand, 30 grand to take them to Disney or take them on a cruise or to Europe, whatever it is. But then you're able to set that goal and say, all right, it's 15 years out, it's 12 years out. And then you can kind of back it into your budget from there.
Exactly. And so we're touching on a lot of topics, and this article is covering them as well, and we're kind of staying in line with them. I want to shift gears to go a little bit beyond the basics, and that is to develop your own, with the help of a financial advisor that you trust, develop a comprehensive financial plan for your life, right? So we talked earlier about saving for college for children, and we've touched on debt, and we've touched on some of these subjects, but they all need to be integrated into a financial plan. And many people, the reason that they start to create a financial plan is they're thinking about retirement, they're approaching retirement. That's something we can certainly help people with. That's the primary source of our clients and is people who are approaching or in retirement. That's tends to be our client base. Of course, we're happy to serve anyone in their financial journey, but when people start to think, well, I want to retire in 10 years, or I just retired, can my money last? That's often when they reach out to a financial planner. And you're welcome to do that. You can check us out at amrfinancial.com or call our office at 866-771-8901. But whoever's listening, wherever you are in your stage, you should start to develop a financial plan, the outline of it, so that you can set your long-term goals and you can be purposeful and intentional about funding those goals, and that you can reach those dreams, those goals that you have are usually achievable if you start early enough and you have that big shovel of income. And so think about all these subjects that we're talking about and all these subjects that are in this article and all those things you know and all those things you don't know, and start to take steps to put them into a document. I think, financial plans need to be in writing, and they need to be updated, and they need to be reviewed. And how do you view that, Jeff? I know you do a lot of financial planning with your clients. Are you surprised by the number of people who don't have that kind of single view at where they want to end up?
I'm not, and one of the reasons is, if you think it, I can make the analogy towards health, and the reason most of us go to the doctor is it's when something is wrong, and that's when that's when we see a lot of our clients coming in to see us.
Yeah.
It's because there's been a certain life event, whether something has caused something to go awry, or they've inherited money, or they've lost money, and that's when they come in. And so similar to how when people say, well, I got to go to the doctor because X happened,
right?
That seems to be the case with people approaching financial planners. With that in mind, we've already talked about, if you think about the different areas of planning, we've touched on the early parts of the plan, and you've got cash flow management and budget. Next, you'd look at risk management. Let's make sure, as you said, we have enough in an emergency account. You want to make sure you have your insurances in place. How do we invest the money? There's investment planning. What can we do to lower taxes? Then there's retirement planning. If you work for an employer, are there employee benefits? Retirement, we're looking at what retirement looks like for you. And finally, at the end of the life cycle, you look at estate planning, because how do you want the assets to flow? How do you want them to be taken care of should something go awry, that your assets flow the correct way, that you're taken care of the right way? So it's all, everything that we've talked about kind of integrates into the financial plan.
It sure does. And as usual, Jeff, we run out of time before we run out of content. So I'd encourage people to check out our website and go amrfinancial.com and go to that resources tab. There's a couple of financial planning guides there to get you thinking. There's one about 40 ways to spring clean your finances, and then there's one on retirement. Both of those are a great read. They will enlighten you and get you thinking. And if we can help you in that financial journey and that financial planning towards your goals, feel free to reach out to us as well. Jeff, thanks for your time.
Thanks for having me.
Always appreciate our conversations, and we're going to be right back with our Chief Investment Officer, Brian Regan, after the break. Welcome back to Something More with Chris Boyd. I'm Jeff Perry, sitting in for Chris this week. And for the next couple of segments here, we're very fortunate to be joined by our Chief Investment Officer of Asset Management Resources, Brian Regan. Brian, thanks for making some time for us today.
Hi, guys. How you doing?
We're doing great. Thank you. So there's always a lot to talk about when we're talking about market news and investing. And I think I'd like to start off with your general comments on first quarter, where it's April now. So the first 3 months of the calendar year in the books. And what's your general impressions? What's your takeaways from how we did for the first quarter?
Well, the first quarter has been excellent. And it just built on a trend that started really going back to October. It's really been a 6-month run of really good market performance, both on the fixed income side and on the equity side. I would say if anything surprises me over the first quarter, it's how strong the equity market has been. We started our first quarterly talking about how we expected it to be, quote unquote, groom slopes since it was wintertime for fixed income markets. And we thought equity markets would do okay, but it would be a tougher slog. And that's, this is very, very early in 2023. So that's certainly still possible. But, the performance has been outstanding. I mean, especially for the NASDAQ, but really all across the board, the NASDAQ, S&P 500, international stocks, a little less so for the Dow, which performed better in 2022.
Mm-hmm.
But one of the things that I think I've noticed the most is it's basically a funhouse mirror of 2022. Everything that worked in 2022 is not working as well in 2023. And we all know that 2022 was mostly a disaster for most markets, and it's been, nothing but blue skies so far here in 2023. So let's hope that keeps up. I think it's mostly driven by the falling of longer term interest rates and falling inflation expectations. And I think all this market performance really runs in stark contrast to what I feel like the typical investor that I meet feels or thinks in their mind. The performance lately has been outstanding, but if you look at bullish sentiment indicators, it's 18 to 20%, depending on what day you look, which is very low, for a stock market that's up 80% of the time.
Why do you think that is? So people should be opening their 401k and IRA statements if they haven't already soon. We should check our statements, people, not every day, but say quarterly. And they, as you said, most people are going to have a positive return for the first 3 months. But I agree with you, by the way, that people still feel it's almost like a hangover from the down market. But why do you think they feel that way?
I think a large part of it is the down market from 2022 still feels real. We still haven't reached a high watermark, right?
True.
So it's interesting if you look at returns over the last 3 years, they're still very outstanding, right? But if you compare where you were at the beginning of 2022 versus where you are now, you're likely not all the way back yet. So there's a psychological game going on, right? But this is why we talk about how you should invest for the longer term. If you invested your first dollar 3 years ago, you're likely very happy with where you sit today.
Right.
If you invested your first dollar on January 4th of 2022, you're probably not as happy, right? But this is why we say stocks are for the long term. In addition to that, I think the financial crisis is still very warm in everybody's memory. I know it's bulleted in my mind. And let's face it, we had some pretty notable bank failures very recently.
It's a good point.
So that puts the fear in people, and I completely understand it. I think what the average person on the street might not fully grasp is this is a little bit different. This was a particular bank in Silicon Valley Bank's situation where it was just really, really poor risk management, not necessarily systematic. But I also think the Federal Reserve and the FDIC learned a lot from the Great Financial Crisis and did the exact right thing by guaranteeing all the deposits, by lending on all treasuries to kind of solve the held to maturity issue. And I think that's more or less put a calming effect on the bank runs. But what it also has done is caused inflation expectations to fall and longer term interest rates to fall, which has been very, very good for stock prices. So this is like the old adage that the economy is not the stock market.
Right.
I think that's 100% true. And bad news can be good news. That's certainly been the case, for certain things. Jeff, you like to point this out all the time, that incorrectly, that headlines are just salacious now. And I completely agree. And they're getting more salacious. And I think with AI, they're going to start tapping into the psychological part of everybody that makes them as salacious as humanly possible. We've become more political. We did have a former president indicted. So all these things can, draw on the emotional heartstrings of people and make them feel a certain way about the world and how it's acting. But it might not jive with the reality of market returns.
Right. And you're absolutely correct that if you sit and watch the news for 3 hours, you will start to think that the world is about to end. And
add social media on top of that,
good point too, right? It's just, you're inundated all day with things that are salacious, and designed to get you to click or stay on the couch and watch the TV to keep you engaged, and they're exaggerated, some are untrue, and some of them don't matter. So to your investments. So good point. You
Most of them don't matter. I'd add in, I wrote an article for thestreet.com that got published this week on Retirement Daily, and I wrote about frauds and misinformation. This is something that I am becoming more passionate about.
I see that. I hear
with
that.
everything that's happening, and it's the more and more this stuff tends to happen, where let's say people get into a cryptocurrency when it's doing really well, and then it crashes. That can just make them feel negative about financial markets,
about everything, right? Yeah,
they start to associate financial markets with how their speculative investment did. Couple that with all the other things that we mentioned, social media and the news headlines, and you can have a recipe for poor sentiment.
So your quarterly AMR Economic and Market Outlook webinar is coming up on April 20th. So for folks who are listening, and if they want to sign up to that, they can go to our website, amrfinancial.com, and you have to register to get the link to view the webinar live. It's going to be at 10 o'clock on April 20th. So if you're interested in Brian's perspective and our CEO Chris Boyd's perspective on all of this, our webinar focused on the market and the economy is a good place to get kind of that unfiltered market commentary and economic commentary without the noise and news of the of your phone or your TV. So I'd encourage you to check that out and see what we have to say on the 20th. Brian, you always do a great job with those, and they're very insightful, and more people are listening to them, not only live, but they're also posted on YouTube for people to go back and review what you said last time. So we look forward to that. A couple things that I wanted to talk to you about. One of them, I'm going to tease and get maybe people will start to Google it. I had to look it up, is roll returns. I've heard the term, and I probably knew what it was once, but it's been a while. So we look forward to educating you educating us on what they are and why they're important and what they're telling us. But before we go to a break, I wanted to talk to you about money supply. There's been, news here and there about our declining money supply. The headline in Reuters that caught my eye was U.S. money supply falling fastest rate since 1930. Tell us why that matters and what it's all about.
Yeah, so we've talked about in the past how the money supply is created. The money supply is created through bank lending. So you can I think of money supply as a proxy for bank lending. So the more bank lending that is going on, the higher the money supply rises. And this is why the money supply kind of rises steadily over time. And the reason why this is a news headline is because it's falling, and it typically rises, slowly over time. It is indicative of the fact that, we do have a banking crisis going on. The Federal Reserve is trying to tighten monetary policy. They're trying to make the cost of money higher, and they're being very successful at it. That's just the reality of it. So I'll have a chart in the quarterly that you teased very nicely. That shows that once those bank failures started happening, the cost of lower quality creditors went up about 1%. That happened without the Federal Reserve doing anything. And then the Federal Reserve came out a week later and raised the short-term Fed funds rate another 25 basis points. So you almost, in essence, if you're not an investment grade S&P 500 kind of borrower, you saw your borrowing costs go up 101.25% in a week. That is some incredible tightening, right? We've seen mortgage rates go from 2 and change to nearly 7 over the last year. Of course, that is going to lead to less demand to borrow money. So if you just think of the money supply, growth happens through bank lending, and you think that bank lending is going to slow down due to recent events, the banks are going to be less willing to lend under the same credit terms, and borrowers are going to be less willing to borrow at higher rates. This is what's going to happen. And this was, the Federal Reserve's intent all along. And it could lead to a recession that we've been saying that we expect to happen at some point.
Don't you think that so the Fed's been increasing rates, as you indicated, the banking issue that with Silicon Valley is related or not related? I guess is some, arguably it's related to the increasing rates, but primarily related to poor management. I get your earlier point, but doesn't the bank failure and the maybe stricter lending requirements increase the likelihood of a recession?
Yeah, I just said that we've been saying that we have expected a recession, and this only makes me place a higher probability on it. And one of the we talked earlier about how the financial markets have been doing well, but sentiment's awful or not doing well. And part of it is because people are anticipating a recession in their mind, and that might affect their daily life, and it might not necessarily affect the stock market. So I think, all that's true, right? You can have a recession, the markets can do well, and you can feel crummy about it. All those things can be a reality on the ground. And I think that's the case.
I know you've talked about this in great detail, so I don't want to belabor something that our listeners may have heard a couple times, but I still think a majority of people who are out there listening make the quick jump. Like, if we are having a recession, the market will go down. I think that's just it may not be correct, but I think it's a embedded feeling that people have. A bad economy must be bad for stocks.
Well, I would say it certainly was bad, right?
Right.
I mean, the Nasdaq was down 30% in 2022. But the stock market tends to anticipate the recovery, and it tends to anticipate the recession well in advance of it actually happening. And I think it's very possible that that's the case, right? We bottomed in October. And part of the reason for that is because interest rates are starting to reflect falling inflation. And now the market's starting to price in the fact that credit will loosen in the future, right? It's not necessarily about what's happening today, but what's going to happen over the longer term. And why is that? Because stocks are long-term assets. That's not to say that we couldn't have, significant volatility if some bad news comes out.
Sure.
Or even if good news comes out, because that would lead to higher inflation expectations, et cetera. But we started this conversation by talking about how good the last 6 months have been. I'm sure I can pick out weeks or even a month that was bad. I can definitely pick out a lot of days that were bad if I were to look at a daily chart.
Right.
But if you concentrate on that, you would have missed out on a nice little run. So it's not really worth to me paying attention to a day, a week, a month, even a single year. It's really key to think about stocks are long-term assets. It's ownership in businesses. Do you like the businesses? Do you think they're going to do well over the long term? Costco is a company that I really admire, and they came out, they report monthly sales results, and the stock was down on Thursday because, for the first time in 3 years, they reported sales results that were down a little bit.
Right.
Why should the stock market, logically go down because for 1 month in 3 years it didn't do, exceptionally better? What you should be looking at is this is to me a very solid business model. That's great. That's fundamentally sound. That has not been easily copied.
Right.
With a great management team, and I expect it to do well into the future. And that's what I'm concentrated on. And if people want to sell off Costco and give me an opportunity to buy even more, I do own it personally, and we own it in discretionary portfolios for clients. Great, please sell it off. I'm happy to buy more.
On that note, Brian, let's take a quick break for a commercial, and we'll be right back. Thanks for sticking with us. This is Jeff Perry sitting in for Chris Boyd this week, and for our final segment of the week, we still have Brian Regan, our Chief Investment Officer, with us. And Brian, just to summarize or just to reemphasize a point there, what I was hearing in all the detail that you provided was, you have to look at this stuff long term. It's so easy to get carried away with the ups and downs of the market, but the history of the stock market, the history of equity investing clearly tells us that when you're in it for the long term and you make good fundamental decisions and you work with people who are focused on this every day, that it's the right place to build wealth long term. But don't get carried away. There's so much emphasis on TV today and among the chatter and social media on trading stocks, if you will, the short-term stuff, that it's important that for our long-term investors, people who are saving for retirement or college for their kids and grandkids or buying that dream house, when you're thinking about long-term, you really need to kind of put the earmuffs on and just focus down the road and rely on history and good management to make sure that you reach your financial goals. So thank you for putting that in perspective. And I'm going to promote one more time your AMR Economic and Market Outlooks webinar. It's going to be on April 20th at 10 a.m. You can register for that at our website, amrfinancial.com. And, it's worth your time to sit in there and listen to information about the economy and the market without all the noise and without someone who may be interested in trying to sell you something at the same time. It's just objective information that's valuable to everyone who's listening.
Yeah, I'm glad you said objective, because I think what you see when you do it is just a lot of data. I didn't massage the data. I pull it and I show it and I explain what it means.
Right.
I don't have, I don't like, what I like to say is I don't have a red team. I don't have a blue team. I'm on the green team. So, that's the whole point of the webinar. Yep.
Excellent. And if people want to learn more about our company, if you're new to the radio show and you're just hearing it for the first time, or you've never checked us out, our website is amrfinancial.com. And we look forward to you checking us out. And we're here to help you if you think we can add value to your financial planning and investing. Brian, you, when we kind of exchanged a couple messages before the show to outline what we might want to talk about, you said, I think I'd like to talk about roll returns. And so most of the time when you say what we're going to talk about, I know I have a good understanding of the general subjects, but I got to admit, I got a lot to learn. It's a term that I was once familiar with, or at least looked at once, but I need a 101 I know this is a level 400 class, as you indicated, but I need a 101, and I think our listeners need a 101 to set us up for what is or what are roll returns.
Yeah, so I was let's say inspired to talk about this on the radio because I went to an RIA summit this week, and I would say most of the time I don't get much out of these RIA summits. They're usually trying to sell somebody trying to sell you something, tell you why they're great and you should use them. And every once in a while I'd say, in a 2-day conference, you'll pick up one nugget that you're like, you know what, that's applicable
worth my time
right now. It's applicable to my clients. It's a useful information. And I would say that this lecture was not applicable to my clients, not applicable right now, but a very interesting topic that I don't think the average person or even the average professional knows much about. And I was, I walked away from that and I thought, you know what, that fund provider might be going through a hard time right now, but in the long run, they're going to do very well. Because I think they're thinking of things a little bit differently. They're going to add value over the longer term. But I think once we talk about what it is, I'll describe why I don't necessarily think it's great right now, and I think why it might be a struggle for certain types of clients. But for other types of clients, I think they're going to do phenomenally well, and I wish them the best. So what is total return?
Yep.
Okay, so the yield curve is typically upward sloping. So if this is fixed income 101, basically the government can typically borrow at 3 months for less money than they can borrow for 10 years. Okay, so let's assume the 3-month rate is 1%, 10-year rate's 4%, and it usually has a nice curved slope between 3 months and 10
The longer you go, the higher the
So
Yield is-
9's typically a little lower than 10, 8's typically a little lower than 8, 7's typically a little lower than 8.
You're saying typically because it's not that way right now.
Exactly, and that's why it's not, this strategy is not necessarily great right now.
Right.
So let's say roll return is basically the return you get beyond the coupon, and beyond the change in existing interest rates. So let's assume for a second that the yield curve doesn't change at all. This mythical yield curve that doesn't currently exist right now. I buy a 4% 10-year bond.
Yep.
3 years, that bond will be a 7-year bond, right? 3 years will go by, that 10-year bond will become a 7-year bond. If I bought the 10-year bond at 4 and the 7-year bond trades at 7, trades at 3, I'm gonna make money because of 3% lower than 4%. That's called roll return, rolling down the yield curve, and you get a return. So, this is a couple things. This takes 3 years to realize, right? But at the same time, you're clipping that 4% coupon, assuming that these bonds were issued at par. So you get 4%, 4%, 4%. You gain 12% in coupon, but you also gain the return you would get from buying a 4% bond that now yields that now is priced at 3%. You get that 1% difference, right? So, you would get, let's call it another, somewhere between 7 and 10% in return from that. So now a bond that would pay you 12%, you're looking at somewhere between a 12 and 20% return on that bond, just because of this roll return. Now, this doesn't really exist right now in the treasury market or the investment grade market, because the 3-month a 3-month bond is between 4.75 and 5, and the 10-year bond right now is at 3.20. So you have the exact opposite. You actually roll up the curve, right? Which isn't ideal. But the roll return does exist in other markets. So it exists in the muni market, for example. There's an argument that it exists in the CMBS market, which has its own hair. But I just think it's an interesting way of looking at of trying to generate incremental returns through the bond market by just emphasizing patience and looking for steepness in the curve. This is something I exercise generally because I understand this, and I always try. You might hear me say I try to target the fat part of the curve.
Right.
The reason why I try to target the fat part of the curve is because that's where I'm getting the most return for the least incremental risk.
Right.
But you're also getting roll return, right? If I have a spot on the yield curve that's gonna have an upward sloping return, well, now I have a negative roll return, right, rather than a positive roll return. But if you always target the fat part of the curve, on average, you're gonna have positive roll return. That's very difficult now, so you're gonna be very short now. And think of more creative ways to try to make money in your fixed income, or just accept the little risk, the little risk high return that you're going to get from, at least right now, from short-term bonds. So, I tried to make it start at 101, and I'm pretty sure I made it pretty complicated, but
you did a good job.
Sometimes I get to have a little fun on the radio too,
This staying on yields and bonds, the spread, if you will, between a short-term and a long-term bond has been squeezing, right? So that it's apparent that the yield curve, while technically still inverted, seems to be heading towards not being inverted. Is that your view as well? By 12 months from now, you think we'll be into a normal yield curve?
Well, I guess I disagree with your characterization of the yield curve a little bit, because if you start at Fed funds and slope it down, it's even more aggressive today than it was, 3 weeks ago. But I think if you compare the 2s and 10s, you're probably right. So I think
that's what I'm talking
distinction.
about.
It's actually getting even shorter is where you need to go. So the yield curve will steepen when we have a recession and the Fed starts to cut. Because what will happen is longer term inflation expectations will go up. The 10-year will either stop falling, fall a little, or even rise, and the short-term bonds will plummet because the short-term expectations for Fed funds will go down because they're cutting, right? Just as they went up as they were rising. The further you go out in the yield curve, the harder it is to predict what it's going to do. That's the reality of it, right? I mean, we don't even know what the Fed's going to do in the next meeting. Never mind the average of the next 10 months, right? Like there's a 60% probability that the Fed's going to pause in the next meeting. That means it's basically a coin flip, more or less in the next meeting. That's like a month and a half away.
Right.
The 10-year price is in, 50 Fed meetings. I mean, that's so, whenever, and when you're thinking about stocks, I know there's a lot of emphasis that gets put on, Fed funds and the 2-year, but what you should really be concentrating on is the 10-year. I mean, unless you're a very short-term trader, which we discourage.
Right.
Every opportunity we get on the show. Which is, a great explanation actually of why we've seen such great performance over the last 6 months, which is what we talked about, in the prior segment.
Well, thank you, Brian. That's, I think one of your roles, maybe you don't perceive it as well as, or the same as I do, but one of your roles with our listeners and our clients is not only, commentary, but it's education as well. So I appreciate you taking these subjects that we don't hear much about and explaining why they're important to us. And, we're all a little bit smarter when we listen to you on the radio or webinar, or I know our clients are smarter when they have the opportunity to speak with you personally. So once again, thanks for your time today. We appreciate it.
Thank you, Jeff.
And thank you for the listeners for sticking with us. I hope that all of you who celebrate Easter have a wonderful day tomorrow at your church and with your families. And once again, our website is amrfinancial.com. You can check out Brian's upcoming webinar, which is April 20th. You can register for that. And one final plug for our spring cleaning resource guide at our website. If you go under resources, there's a couple of resources there for your spring cleaning of your finances and retirement planning. Check them out. Until next week, when Chris Boyd will be back in the big seat, keep striving for something more.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.